Hello and welcome to Quartic. This is episode 8 in our series, CFA Level 1, 10 Topics in 10 Weeks. The topic for this week, topic number 8, is derivatives, which accounts for 6% of the exam. Now this is a relatively short topic as there are only 2 readings. The first is derivatives markets and instruments. This reading introduces the idea of a derivative being a financial instrument which derives its value from the value of something else. The reading presents forward contracts, futures, options, swaps, and credit derivatives. Now you'll need to be familiar with the basics of all of these, as most of these will be analysed in more detail in the next reading. Know which types of contracts are exchange-traded versus over-the-counter traded, noting that an exchange-traded contract will be standardised. It will be traded in a central location. It will be subject to clearing and settlement procedures and may require margin payments. Now, this is in direct contrast to over-the-counter contracts, which can be customized, which don't require margin payments, but are less liquid and subject to counterparty risk. Also be aware that exchange-traded options and futures give rise to a forward commitment, whereas over-the-counter forwards, swaps, and options are subject to contingent claims. In general, you've got to understand the differences between forward contracts and futures, especially how they are traded, things like default risk, timing of cash flows, and also margin arrangements. In terms of swaps, know the basics of swaps, in particular plain vanilla interest rate swaps, and know the very basics of credit default swaps. The next reading looks at the basics of derivative pricing and valuation. Note that this is a more complex reading than the first and might therefore take a bit more time for you to get to grips with. Begin by understanding the distinction between pricing and valuation of forwards, futures, and swaps. Note that the price of a contract is the amount at which the two parties are contractually committed to trade at settlement, whereas the value of the contract at any point in time prior to expiration represents the amount that another party should be prepared to pay in order to take over that contract. For forward contracts, know the components of pricing, including the risk-free rate, costs and benefits of carry as well. Understand the process of valuation at initiation, at expiration, and also at any point in between. Know the basics of valuing swap contracts, noting that the value of a swap at inception is going to be 0, but can become positive or negative immediately after. Understand all the factors affecting option pricing, including the underlying price of the asset, the strike price in the contract, time to expiration, risk-free rate, and volatility, as well as we said before, payments and costs of carry. The minimum values of American and European calls and puts are highly examinable. Put-call parity as well is fundamental to option pricing, including for synthetics and arbitrage, so make sure that you are familiar with the basics of this. And finally, know the basic construction of the binomial model for option pricing, including the risk-neutral probability and the hedge ratio. You will see this again at level 2, so it's probably a good idea to invest the time now to learn what you can in this regard. So that is it for this week. Thank you very much for watching. For free access to Quartic Online, please get in touch by using the details on the screen. Also, you can follow us on Twitter @Quartic Training for access to more videos and useful resources.